Hey, one more thing. We talk about the Federal Reserve like it's all powerful. I know, look, I'm guilty of this myself. But while the Fed can make things better or worse, at the end of the day, we still have a market economy. And markets are inherently boom and bust creatures. Now, you could have the most sagacious Fed chief in history. They still wouldn't be able to stop a truly terrible recession in its tracks. So if you want to manage your own portfolio of stocks, rather than just sticking your money in an index fund and forgetting about it, this is what I care so much about. You should try to get your own read on the economy. Remember, I favor index funds for bedrock investing and then stocks for your discretionary mad money portfolio. That is a radical view. I don't care. How do you do it? It's not like most people are speaking to CEOs every day and getting a really in-depth look at how their businesses are doing. Beyond watching me, which of course goes without saying, what else can you do? What else can you look at? Maybe someday Elon Musk will come up with a chip that lets you download CNBC directly in your brain. For now, though, we have to do things a somewhat old-fashioned way. For example, when the economy's humming along and the employment numbers look incredible, you need to watch certain key groups of stocks that will often signal when a slowdown's on its way. Some sectors are a lot more economically sensitive than others, or they just tend to get hurt early on in the course of recession. All right, so let's take housing and automobiles. When the economy heats up and long-term interest rates rise, something that happens naturally in expansion, well, that eventually crushes the home builders and the car companies. Why? Because the moment it becomes more expensive for consumers to take out a mortgage or get financing for a car, well, they start getting their sales hit. So when you see the stocks of the home builders and the autos performing terribly, that's often a signal telling you that the economy is about to peak. At the very least, it means lots of investors are betting on a peak. You often see these two groups collapse several months before the Fed starts raising short-term interest rates. They tell you ahead of time. What else? There are all kinds of basic building block commodity companies that get hammered in the early days of the slowdown. The paper stocks are a good example. The commodity chemical makers. Paper declines can signal less packaging. Think linerboard. You need it to ship just about everything, so it's a great barometer of global commerce. Plastic, like it or not, goes into everything, and it's a real good tell. Of all the metals, copper's the most sensitive. You watch the price of copper, and it'll tell you a lot about the global economy. Copper actually peaked a couple of weeks before the Fed first raised interest rates in March of 2022. Then the price of the red metal plunged through mid-July before finally finding its footing. At that point, everybody understood that the economy was rapidly decelerating thanks to rampant inflation, which led to the Fed's aggressive rate hikes, the only real reliable way to stamp out inflation. So here's the bottom line. The action in the stock market doesn't always sync up perfectly with the real world, but various sectors come in and out of fashion based on the real-world health of the economy. You need to know how to take the economy's temperature and look at the unemployment rate or listen to pundits. Even me doesn't really cut it. So watch the home builders, watch the automakers, watch the paper stocks, and particularly watch the price of copper. That way you won't feel clueless the next time something goes wrong, and you'll have a much better idea of what to do with your stocks. Stick with Cramer.
Coming up, Cramer's taking your questions. Don't miss his deep dives into the trickiest parts of this tape. Next.
Am I happy? It's the lightning round! Lightning round! Lightning round! Lightning round on Cramer's Mad Money! This is where I take your calls rapid fire. This is where I take your calls rapid fire. Rapid fire calls. Rapid fire calls, one after another. You just say the name of the stock, I tell you whether to buy it or sell it. That's where I take your calls rapid fire. You say the name of the stock, I tell you to buy, sell, sell. I don't know the stock price of the calls ahead of time. Buy, or sell. You know the start of the stock run of my stampers. Play this out. And then the lightning round is over. Are you ready, Ski Daddy? Ski Daddy! Are you ready, Ski Daddy? Booyah, Pop! Booyah! All right. Mark in Hawaii. Let's go to Janet in Colorado. Janet! Let's go to Kyle in Oklahoma.
Hey, hello, Professor Cramer. Thanks for making my life a little happier place to be.
POP. Pepsico.
Oh, I love that booyah.
Super five, booyah.
I am ignoring that entirely.
This is an exam cramming, ramen noodle eating, college like booyah from Colorado State and Fort Collins. Kramer's ice cream booyah.
You are so hot on all your picks.
Yeah, what do you want?
I want to say thank you for not just the money, Jim, but what the money translates into, in my case, a college education for my son.
They have no respect for when I am talking about a company that I just bought a tuxedo at.
I taught high school for 42 years. If your show was a required part of life skills classes, we'd have generations of financially savvy Americans.
Yeah, Regina, help me. I want to tell that guy who's ringing the buzzer that he is about to be fired if he ever does. Where is he? Come on, come with me. We're finding this clown. Is he back here somewhere? Who is buzzing me? Who is buzzing me? Which one of you? You're all fired.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.